As I look out into 2026, I actually see more risk in NVIDIA than I do in Bitcoin. I think Bitcoin is fait accompli on the big characteristics of regulatory progress, institutional adoption, continued debasement of the US dollar. I look at NVIDIA, there are questions about an AI bubble, there's rising competition in the chip space. I think there's a lot of concerns about large cap tech. I think Bitcoin's going to continue its trajectory of being lower volatility with still high prices. That makes it a very attractive asset. Higher prices, lower vol. I think it's going to create a reflexive loop where people want to buy it.
For more than a decade, crypto investors have leaned on a simple mental model: the 4-year Bitcoin cycle. 3 years up, 1 year down. A pattern etched into market psychology by brutal drawdowns in 2014, 2018, and 2022, each marked by declines of roughly 60%. If history were destiny, then 2026 should logically be another painful down year. But according to Matt Hougan, that assumption may be one of the biggest mistakes investors can make right now. In this video, we're going to unpack why the traditional 4-year cycle may be breaking down, why 2025 was secretly one of the most important years in crypto history despite weak price action, and why the combination of institutional adoption, regulatory clarity, and macro forces could set the stage for a powerful move higher in 2026 and beyond. This isn't about hype. It's about fundamentals, capital flows, and understanding how markets evolve as they mature. Let's dive in. Before we go on, just a quick reminder: liking the video, subscribing to the channel, and commenting helps this reach more people who care about Bitcoin and macro trends. Appreciate the support. Let's continue.
First of all, the 4-year cycle, Bitcoin's historically moved in this 4-year cycle of 3 big up years and a pullback year. The pullback years have historically been down like 60%. They were 2014, 2018, 2022. You can do the math. The next one would be 2026. So according to this 4-year cycle that a lot of crypto talks about, this should be a down year. I don't think that's going to happen. I think it's going to be an up year. The reason is we had a pretty bad 2025. And as I mentioned, the price fell when I thought it should have gone up based on fundamentals. So I think there's some catch-up value. But more than that, I just think the wave of institutional capital is too big to keep this market down. We mentioned approval of Bitcoin ETFs on all 4 major wirehouses, institutional adoption, sovereign adoption. These are institutions that move money on the scales of tens of billions of dollars at a time. And I think that's just too much demand to keep the price down. We have some selling from OGs, but there's this institutional wave, this regulatory wave is too positive to move the market down. On the flip side, this volatility question, crypto's volatility has been declining over time. So actually, all I'm projecting here is that will continue. And in fact, for 2025, we were about as volatile as NVIDIA. As I look out into 2026, I actually see more risk in NVIDIA than I do in Bitcoin. I think Bitcoin is fait accompli on the big characteristics of regulatory progress, institutional adoption, continued debasement of the US dollar. I look at NVIDIA, there are questions about an AI bubble, there's rising competition in the chip space. I think there's a lot of concerns about large cap tech. I think Bitcoin's going to continue its trajectory of being lower volatility with still high prices. That makes it a very attractive asset. Higher prices, lower vol. I think it's going to create a reflexive loop where people want to buy it. There's an old saying about people's careers that there are years you learn and years you earn, which is to say there are years when you're sort of building as a person and then years where you monetize those. That's certainly true for many entrepreneurs, where the journey is an infinite amount of work and then hopefully a payoff at the end. I think that sort of feels like what 2025 was in crypto. As you mentioned, we had these incredible fundamental advances. From a regulatory perspective, we went from a really toxic environment to a really positive environment. From an institutional adoption perspective, we went from one where crypto really wasn't mainstream. It wasn't approved at any of the major wirehouses. You didn't have major endowments or sovereign wealth funds investing. To the end of the year, every wirehouse allows crypto investment. Harvard's largest liquid position is Bitcoin. We've seen multiple sovereign wealth funds come in. It's really gone mainstream in the institutional community. We also had some real growth in real world use cases. You mentioned stablecoins. They sort of came of age last year. We got the passage of the Genius Act to give them a firm regulatory framework. And we saw major Wall Street companies acknowledge and build on stablecoins and tokenization. So from a fundamentals perspective, maybe the best year ever in crypto. That's sort of a crazy thing to say, but I don't think it's unreasonable. Certainly the best year since I've been full-time in crypto, which is 8 years. This was the best year for fundamentals. But as you said, prices went down or nowhere. Bitcoin ended the year, down a little bit, but it felt worse than that because it went up to 126,000 and then came all the way back down and then some. Altcoins did even worse. The most speculative coins really got kicked in the shins and fell spectacularly. So what does that tell you? I think what happened, just to give you a 30,000 foot view, is Bitcoin ran up to $100,000, and that was a big behavioral sell wall. And a bunch of OGs decided they wanted to sell. And then that selling in Bitcoin trickled down into the rest of the market. And that's way too simple because there was a lot going on in crypto. But I think if we look back at 2025, we'll say, people had invested in crypto for 15 years. The price of Bitcoin ran from $0 to $100,000, and they decided to take some chips off the table. The institutions bought those chips, but not quite enough to push us to where I thought we would have gone. They didn't buy quite enough. I think where it leaves us going into 2026 is one of the rare moments in crypto where the fundamentals are better than the price. Historically, the price is ahead of the fundamentals, like speculative froth. And right now we have the fundamentals ahead of the price. It makes it very attractive for long-term investors. But that's kind of what I think happened last year.
So, why didn't prices rise if fundamentals were so strong? Hougan offers a simple but powerful explanation: behavioral finance. Bitcoin hitting $100,000 wasn't just another number. It was a psychological milestone. For investors who had held Bitcoin for 10 or 15 years, this represented generational wealth. Many decided to sell. This OG selling created a supply overhang. Bitcoin selling cascaded into the broader crypto market, dragging down altcoins even further. Institutions stepped in and bought that supply, but not fast enough to fully offset the selling pressure in 2025. The key insight is this: OG supply is not infinite. At some point, those long-term holders finish distributing. When that happens, the persistent institutional demand remains, but the sellers disappear. That's when price dynamics change dramatically.
It's important to note that the lower interest rates are less lower than the last few times we talked about lower interest rates. Over Bitcoin's history, interest rates were on a yo-yo, right? They would skyrocket to 4% and then crash to zero, right? The COVID pullback to zero. Now we're talking about fiddling on the edges, 25, 50, 100 basis points. But broadly speaking, lower interest rates are good for risky assets. Crypto is a risky asset despite being less risky in the past. So if we see lower interest rates, that will be positive. I actually think the bigger thing may be who is the new Fed chair. The two leaders in that, Hassett and Warsh, have slightly different views on the role of the Fed. Hassett is much more likely, in my view, to aggressively lower rates and to use the Fed's balance sheet to support the economy. Warsh is more likely to go back to sort of Greenspan era, less interference. And therefore, I think if we see a Hassett Fed, I think that's also a catalyst along with interest rates. If we see a Warsh Fed, maybe it's a non-event or maybe even a slight tail, a headwind, but probably a non-event. So I think that's just as important as whether we get 25, 50, or 75 basis points, is who is in charge of this institution into the future.
I'm curious how important you think institutional adoption is to crypto overall. You hit on it earlier, but offer some more context here on how important this might be.
Yeah, look, professional managers control all the money. You know that, I know that. The majority of money is not controlled by retail self-directed investors in the US or globally. It's controlled by institutions, family offices, and financial advisors, right? They control, 30, 40, $50 trillion of wealth. If it becomes normal for them to have 2%, 3%, 5% crypto in their portfolios, you're talking about hundreds of billions of dollars of investment over time. That's why this is important. Crypto has been built on the backs of retail self-directed investors who are an increasing share of the market. I don't want to minimize their role, and they're important to crypto in the future. But if you see, an institution like Morgan Stanley, which controls maybe $5 to $10 trillion of wealth and just filed for its own Bitcoin ETF, if they're putting 2% of that wealth into Bitcoin, that's $200 billion of flows, right? I mean, it's just the scale of it is bigger than you can imagine. Try to put $200 billion into a $2 trillion asset and see what the price does. It's going to go up substantially. So that's why these institutions matter, because they control most of the money. They're broadly starting at zero, and I think they're going to end at something like 5%. And the speed at which they get to that is really going to influence crypto, Bitcoin, but also Ethereum, Solana, and other large caps in the space. The ETFs are absorbing the selling of OG and traditional investors, and it's just a ratio. The thing I often point people to, because of what happened last year, is actually gold. Everyone knows that gold had a tremendous year in 2025. It soared to new all-time highs. It ripped. It was the best performing asset in the world. And when people note that, they say, what drove it? It was central bank purchases. But if you actually look at the data, Nate, what you see is central bank purchases ramped after the U.S. seized Russia's assets. And they went from about 400 tons a year to 1,000 tons a year. That's a lot of gold. So in 2023, central banks bought 1,000 tons of gold. The price didn't do much. In 2024, they bought 1,000 tons of gold. The price didn't do much. In 2025, they bought 1,000 tons of gold, and gold went parabolic. And the reason it took 3 years is because of those first 2 years, there were existing holders who were willing to sell. And they were willing to sell, and miners were willing to sell. And then they ran out of gold to sell, but the demand was still there. And when that moment happened, the price went parabolic. So I think what we saw in 2025 is you had institutions playing the role in crypto that central banks did in gold. Persistent buying demand. You mentioned the statistics, buying more than 100% of the supply. And you had some existing people that were willing to sell. And maybe in Q1 or Q2 of this year, they'll continue to be willing to sell. But it's not an infinite supply. At some point, they will run out. And Bitcoin will have the same experience that gold did in 2025, which is, I think, the price will go parabolic. And to me, it's just a matter of time as long as that institutional demand persists. And I expect it to not only persist, but accelerate, because you have all these platform approvals and other things happening. The ETFs themselves, reflect people's demand for this asset. There are other parts of this market that matter a lot. That was true in gold too. The ETFs weren't the only source of demand. There's jewelry and bars and central bank and industrial demand. In crypto, that is true as well. I will say one thing about ETF buyers is that they've proven very sticky in Bitcoin. Bitcoin had a rough Q4, and ETF inflows didn't accelerate, but they didn't really see substantial outflows. I'll give you a preview. As you know, Bitwise does a survey of financial advisors every year. We've been doing it for 8 years, asking about their attitudes to crypto. We haven't published the 2026, but a preview stat is 99% of advisors who had Bitcoin at the start of 2025 plan to hold it or increase their allocation in 2026. So even though it was a challenging year, they're doubling down. So yes, ETFs are just a part of the market, but it's a very sticky part of the market, and it is a substantial source of demand.
If you take one idea away from Matt Hougan's perspective, it's this. Crypto is in one of those rare moments where fundamentals are stronger than price. That doesn't happen often. The market has spent years building, through regulatory battles, institutional skepticism, and brutal volatility. 2025 was a year of learning, not earning. But those learning years often precede the biggest payoff. With institutional demand growing, OG supply fading, volatility declining, and macro conditions stabilizing. The setup for 2026 looks nothing like past down years. History doesn't repeat, but it often rhymes, and this time the rhyme may sound a lot more like accumulation than collapse.